Hello, everyone, and welcome to our webinar. It's about time to start. So I would like to welcome everyone wherever you are joining from. We recognize some names from all over the world. Of course, we are based in Iceland, and Natalia is in London. We have people in Brazil, so please be welcome. My name is Alondra, and I am the Chief Marketing Officer at ICR. I will be hosting today. I'm very happy to have my speakers with me. I would like to say that it is our honor at ICR to host this event and tell us a little bit about the work that we have been doing with Kita. Our speaker today, Natalia, she's the founder and CEO of Kita, and I would like to invite her to introduce herself.
Oh yeah, of course, thank you. Yes, I'm Natalia Dorfman. I'm one of the co-founders and CEO of Kita. Kita is a specialist insurance company, so the only thing that we insure are transactions within the carbon markets, and our goal has always been to use insurance as a de-risking mechanism, but also therefore as a way to help drive more finance to scale high-quality carbon projects. And as we will talk through much more on this session, we've always seen a lot of complementary overlaps with carbon standards and insurance, and so it's very exciting to be working together with ICR and to speak with all of you today.
Thank you so much. And then our second speaker is Oli Torfason. He is a COO at ICR. He's also sitting in the same room as me. And yeah, welcome, Oli, and please tell us a little bit about you and your background.
Yeah. Hi, I'm Ole. I'm Chief Operating Officer at ICR. I focus mostly on business development and getting the operations day to day. For us, working with Kita, we've been looking at this space for quite some time, and it's very exciting to see how many joined up or signed up for this call today. So I'm just very happy to continue and get the conversation going.
Yes, thank you, Oli. We have 42 people joining right now, so we are very excited to start delving into the conversation. The agenda for today will be to start with a chat, what we would like to call a fireside chat, so a little bit more informal, something more cozy, where we will talk a little bit about what we've been working on. And then the other half of the agenda will be Q&A. So you can hold your questions or submit them now, but we will address them. And then later on in the Q&A, Gumi, who is our CEO, will join us to answer some. So let's get right into it. I mean, I would like to start by asking Natalia, how do you think this partnership that it's aiming to innovate in regards to insurance in this space? We believe this partnership is probably unprecedented. So we would like to know, I mean, what exactly is Kita doing? What is ICR doing? And why did you decide to work together?
Yeah, of course. So one, I guess the sort of first point, I think for any insurance company entering into the carbon markets, I think it's very hard to look at the carbon standards and not see some complementary overlap, right? Because at the end of the day, what we're both doing is looking at quality, we're both looking at risk assessment, both looking at risk management, and we're also both looking at risk transfer, which I recognize is it's a sort of insurance industry word, but what it basically means is transferring the risk away from a party who's holding that risk and might not be most well placed to hold it, and transferring it to a counterparty who's better placed to hold it. That's core to what insurance is, but it's also what carbon standards do with their buffers. So on one hand, as soon as we started Kita, we were looking at the carbon standards and the buffers and thinking there must be a way that the insurance industry can actually come in a complementary partnership-driven way, work together. And so thus, delighted to be working with you. In terms of what we're doing, so there's sort of two categories of it. One is what we call buffer as a service. And so this is, think of it as independent management of ICR's buffer. So any carbon standard right now that holds a buffer is currently managing that buffer itself in-house. When you look at the financial services industry, usually there's specialist companies that come in and do portfolio management. And that's in essence what we're looking to duplicate here. So Kita is doing independent management of ICR's buffer. The goal is to help to identify and reduce risks, to increase operational efficiency, so economies of scale in terms of how we do those risk assessments and the ongoing due diligence and scenario analysis, etc. And then over time to reward the best performing project developers. And I know we can get into a lot more detail as to how exactly we're doing this, but that is the core of it right now, is buffer as a service, looking at that independent risk management of ICR's buffer, where we'll be looking at the risk assessment of the individual projects, ongoing scenario analysis across the portfolio, and then leading into transparent reporting. And I think for all of us, one of the goals here is really to reward those best performing project developers who are working with ICR. The second side of it, of course, is insurance. So I will say buffer as a service is not an insurance policy. It is risk management, most akin to financial industry portfolio management. It is, of course, very complementary to insurance. And one of the things that I think is interesting about ICR is that within the carbon standard, you already had outlined how insurance can be used. So for example, for ex-ante credits, I know Ollie, you'll know the exact wording, but in essence, it's for ex-ante credits for project developers who qualify to issue ex-ante credits. If you have delivery risk, you can issue 100% of your ex-ante credits. And if you don't have delivery risk insurance, you can only issue 50%. And so thus, the incorporation of delivery risk insurance into your standard is actually a very helpful tool for those project developers to increase their liquidity at an early stage of the project. However, I think one thing that we talked about with delivery risk and what we've seen in other standards is that insurance is kind of indicated, but it's not outlined as exactly what insurance could be purchased, what it looks like, how you access it. And so one thing that we're working together on is to put in that outline. So actually, if you say a developer can buy delivery risk insurance, now this is exactly what you can buy, and here are some providers you can buy it from. And I will say we're not specific to Kita, we're looking to create a framework that the insurance industry could come into. So that's one on the insurance side. The other big insurance point that we've been discussing is around political risk in Article 6. So of course, many project developers and standards, anyone who's listening on this call will be looking at CORSIA and TAB and what they've been putting in terms of the obligations that if you have a loss of your corresponding adjustment, the obligation to make good that loss. And clearly insurance comes into that. And again, we've been looking at how we incorporate that insurance into ICR. And I think that will be part of our work going forward, is again looking at the evolving risk profiles of projects in the market and looking at how do we incorporate insurance effectively into the ICR standard so that your developers, buyers, investors, etc. can access it. So I say that for the intro, that's the high level, is that we see it really complementary. We're doing buffer as a service, which is that risk management of the buffer. And then we're looking at the different insurance products that can be provided. But all of it really is to help to manage the risk, not just now, but in an ongoing way to create those economies of scale that hopefully create economic benefits for the developers.
Great, thank you for the great introduction. I mean, I remember listening to an interview with you earlier this year with Rene Velasquez, and you were talking about the buffer as a service then. So it's our great privilege that, you know, later, just this year, we started working in this collaboration and bringing this product into life, which you know, takes me to my next question, which I would like to Oli to know. At ICR, we are at the center of the value chain, and we are working with stakeholders in both the supply side and the buyer side. So we would like to know, I think people in the audience would like to know, how can you, with ICR and Kita, develop this buffer as a service and incorporating this level of like third-party risk insurance to everyone in the value chain?
Yeah, thank you. Thank you for that. I think to describe it perhaps in a simple way, we at ICR have always been advocates for having specialized roles, having specialized like the validation and verification bodies, they have a very specific role. The standards, they have a very specific role. And sometimes, and perhaps in this current space, these stakeholders are wearing too many hats. So we see a benefit in bringing specialized knowledge into the field. And using the buffer as the first step is very easy to do, so to speak. I mean, this is a form of a very primitive insurance, a communal or a communal insurance pool, so to speak. So, but it can be improved, and I totally understand why it is set up in the way that it is, and it's also hard for insurance to just step into insuring or managing buffer pools at ground zero. But I believe now we are at this interval where we can actually take the next step because we have some learnings from the past. And to add to what Natalia mentioned earlier is that standards and risk or insurance companies, we are looking very much at similar things, but in my mind we're looking at it from a different point in time. So what that means is that we have standards, and even like ICROA and like VCM and everyone who is working on things, we're trying to prevent bad things from happening. We're trying to set it up in a way that to reduce the risks of how we can implement things. But then insurance, they look from the future. They sort of, when things actually go wrong, they will be there to clean up the mess, so to speak. And I think it's very good to have these different roles because it allows them to be just hyper focused on these things, whereas we can also create a better loop of feedback on how we can iterate and improve. So I think that yeah, the buffer as a service, and then moving into insuring the buffer and more specialized insurance products is very helpful. And also just to stress that it's very important to have insurance in the field, especially in the ex-ante issuances, because that can really unlock a lot of capital for project developers when it comes to selling credits.
Thank you, Oli, and it's very interesting what you're saying and talking about the different stakeholders. Recently, when we announced our partnership, we also published an article together where we specified different risk stakeholders. So I would like to ask Natalia, from that point of view, who are these risk stakeholders from your point of view, and why does insurance matter to each one of them?
Yeah, of course. And I guess before I say that, let me just, something I forgot to say, which actually when Ollie was speaking, it reminded me. One of the things we actually really liked about working with ICR is this buffer as a service is very much pulling from the financial services industry. And we really like working with you because both you're very focused on innovation, but you also have very, very strong existing governance structures and risk management frameworks. And so it's been very effective to sort of come into an existing structure with that financial services mind frame to work with you. And I think one of the things we do hope is to create a sort of positive framework that the rest of the market can follow. And that leads very well into the risk stakeholders point. So the risk stakeholders, I think at a high level, we're talking about the different players across the market that are focused on reducing risk, enhancing transparency, and ensuring accountability. And we're doing this in different ways via the assessment, management, and mitigation of risk. And I think you can divide them into the project level, so people looking at projects, and then people looking more at an industry level. And so on the project level, I think if you think of almost like a little sandwich, you've got the standards. I think we termed the standards in the article we wrote as the foundation It's like you're setting the frameworks, right? The methodologies are like literally how we are doing this, like how we are quantifying the credits. So you are absolutely foundational to the entire market. Then you have the insurance. I think we termed us the regulated safeguard. Right, so insurance, Ollie, like you mentioned, is very much there when things go wrong to be that safety net to help people have the financial resilience to set things right. I think we also very much think of insurance on the flip side. So via helping to outline risk management frameworks and helping any buyer of insurance, whether it's the developer or the financier, fit risk into a risk management framework that works for their business, you can actually very much help industries scale. And you can help drive finance. For example, the financial services industries like banks will very often require insurance for loans. And so insurance then comes in as that kind of safety net and setting the path forward. And I think we are probably right now one of the few regulated entities in the market. So we very much have rules we need to follow. And if we insure a project that doesn't do well, we also have skin in the game, right? We're going to pay a claim. So you sort of have the standards and the insurers, I think, hugely complementary and sort of almost sandwiching the market. Then you have the ratings agencies. I liked, again, we said the shorthand signal, right? For the buyers, it's like, is this good or not? I don't need to read, I just want to know, is this good or not? You definitely have the ratings agencies playing a role. And then you have the MRV, and increasingly the digital MRV is that kind of ongoing transparency and data and really enabling the others. And then on the industry level, you have the endorsements, sort of the gatekeepers, right? You have VCM, you have Corsia, you have Acroa. You're setting that, again, that kind of gatekeeper of who should be trusted, particularly, I guess, across those project level risk providers, and then their accreditation bodies. And I'll say, I think there's probably not enough accreditation bodies that are utilized in the market. I think we look at them very much for VBBs, who I realize right now I forgot to say is another project level risk assessor. But the accreditation, I think, is important. So again, coming from the insurance industry, you would only work with an insurance company that's licensed to do what it's doing in the jurisdiction that you need it. And I think that accreditation bodies are important for the market as well. So it's looking at those different players within the market who assess risk in all of their own different ways. And then, like Ollie said, looking at their area of specialism and trying to build a market that enables them to focus on what exactly they do best, rather than expecting people to do everything and have this huge range of skill sets within what could be a small team.
Thank you, Natalia, for specifying each one. There are a lot of stakeholders involved, and we are always thinking, because you talked a lot about innovation and how you like working with us, and I think that we kind of echo your words, that what we love about working with you is also your innovative approach, because coming from insurance, we would think that you're on the more conservative side, but that is not the case for Kita. We actually love how agile we can be and working together and developing these very sophisticated risk assessment tools that are completely new to this space and this industry that is maturing slowly. And I would like to ask you, in this regard as well, do you think that this will drive market leadership and eventually become the standard in the industry? Is that what we're aiming for?
I mean, I guess I have a bias in this question.
We all do.
I hope so, to be honest. And I think one thing that we've always tried to do with Kita is think about, I guess, something that's greater than ourselves, right? We all got into this industry because we believe in fighting climate change. And so if we build a hugely successful business and I'm a multimillionaire and happy for me, but if we never had an actual any impact in fighting climate change, that wouldn't make me very happy. And so a lot of what we try to do is really thinking, is this useful for the industry rather than is it useful for Kita? Although hopefully, obviously, we'd like the two to sync up. And I think this is one of those things. So I do truly think that, I mean, carbon standards obviously play a huge role in this market. And without the methodologies, we have nothing. And those methodologies need to be strong, and they need to be updated, and they need to be pulling in all the latest science, and they need the smartest people working on that. But should those carbon standards also to be required to have in-house teams that in essence pull the same expertise that you'd expect to see in the insurance industry or the hedge fund industry. And should you have access to those same tools and same data sources that we have access to? And do you need to, as what's often a nonprofit? And I would say that arguably those skill sets fit best within the industries that actually this is just what we do. And if we can then form a collaborative working relationship, I think, again, it provides that economies of scale, right? So what we're doing really with Buffer as a service, one of the core aspects of it, the beginning of it is sort of risk advisory work. So looking at the projects you already have and the projects in your pipeline and looking at putting them into standardized risk frameworks such that we can do scenario analysis across the portfolio and come out with a kind of apples for apples type assessment that enables, you know, Ollie and all of you to look at your pipeline and your buffer and be able to say, yes, this is meeting the KPIs we expect it to meet for permanence, or no, maybe it's not, maybe you need to make some changes. And once we've pulled that data into a system that we hold internally, we can actually update that on a relatively frequent and relatively easy basis. And then second, when the projects come in, and so an individual project comes in, and of course still ICR is in charge of determining whether or not this project is one they want within the ICR standard, but then the actual risk assessment to determine the buffer contribution level. That again is something we do every single day, because whenever a project comes to us and asks for an insurance quote, what we do is a risk assessment on that project in order to come out with a premium that is based on what we perceive to be that project's risk levels. And so again, the economies of scale, if this is something that is just what we do, it's our business. And if we can provide that service to you, it's a much more cost-effective way for you to get the same outcome without needing to have that type of team and expertise in-house. And so I do really think that actually, if it's a model that can be more replicated across the market, it's one that would free up a lot of time within the carbon standards and enable them to focus on what I really think the market needs, which is probably just that core methodologies. And I recognize you more. I recognize you do a lot, but I think it could free up some time and resource to focus on what is probably most core and what can't be provided to another service provider. So yes, I do hope it's adopted more widely within the market. And then again, leading into the sort of the buffer itself and the potential to insure the buffer, or the potential to link that with insurance that actually replaces or reduces buffer contributions. Again, they're so complementary. Once we're working with you to do the risk assessment of the projects within your portfolio, we now very much understand the risk levels that enables insurance. And again, I think insurance, the core of insurance is to basically take risk that is insurmountable for one and pass it out onto the shoulders of many, so it becomes a manageable risk. And again, I think insuring the buffer and insuring projects enables reduced risk on that individual basis, and thus provide a lot of cost efficiencies for everybody. And in a market where margins can be quite tight, I do think it would be a useful model to adopt. But likewise, I think again, working with ICR is great because we can be fast, but also you're large enough to have an impact, right? You have a pretty sizable pipeline of projects. And so I think it's one that we can hopefully prove to the market. And then I guess final point I'll make here is I think as eventually carbon credits likely move towards being more of a regulated asset class, you might look to expect anyone holding that type of asset to need to treat the asset like a wider financial services industry might, so looking at stress testing, for example. And again, the more that carbon standards can start to look ahead and say, how would I stress test? Like, how would I do that? Who would I bring in to do that for me? The more you can be prepared, I think the better. And again, working with external risk advisors, it doesn't have to be Kita, of course, but I think that's probably a helpful thing to do to set yourself up for what I think will be a future eventuality.
Yeah, I think it's great that you end up with talking about like what we envision and where we expect the market to go. And I think, of course, insurance, it's a great player here to make it more serious, make it more bankable, as they say. But I would also, we've heard from your point of view, what we're doing now, what we're thinking, but from the point of view of ICR, I would also like to ask Oli, like why did ICR chose to work with Kita And also, like, what efficiencies do we think more like on the day-to-day basis at a project level, at a project developer level? What efficiencies are there to be gained in the kind of like short to mid-term?
Yeah, thank you. Yeah, definitely. So I think one of the key things that I really like about having, like in general, having insurance on board is, like Natalia said, skin in the game. It's actually like insurance can provide and unlock so much funding, and they can become a huge investor, even though they're basically investing on the other side. But they are there, and so they become backers of carbon projects via proxy. So that's one of the big things that I see insurance playing, is just to an influx of capital. Essentially, both they're incentivizing and also they are putting their own skin in the game. And I also like the approach. I think like why we are working together is that I think we're both kind of innovative in the approach, but also like I think the ICR is of that size. It's big enough, but it's not too big. It's we have relatively new projects, and we have a variety of projects. So it's almost like a good portfolio to start with innovating. And I totally just to be very plain and clear, I also hope that we will be able to contribute to learning of the market in whole, and hopefully figure out ways to improve, and we might even figure out that we did not find always the right ways to improve, and that's also part of the learning to figure out where the walls are. And yeah, like I sometimes say also, like the reason why we want to have different roles is you can't build a hammock on a single piece of string. You need to have like different ropes, and you need to have you need to tie people together. So once you have more people, you have more relationships, more voices. We will have a relationship with the insurance body. We will also have a relationship with the validation and verification body. They will have their own relationships, and so it becomes like a more dynamic discussion, and it will just enable everyone to do things faster, better, and more secure if we do things right. And cooperation is just at the heart of that. So sharing information, trying new things, and trying to move fast rather than figuring stuff out before we try to do it. So that's why it's also very great to have insurance to help with the risk of doing things faster.
Mm-hmm. Great. I mean, I think in terms of like getting into it, I'm not sure if we would like to start discussing a pricing, or because like these are kind of questions that will start to be on people's mind, but maybe we should also consider if we want to see the Q&As. I don't know if that's something that people are thinking about. Is there anything you would like to share in that regard?
I think the pricing, and Natalia, you can also pitch in. I think pricing will evolve. The overall aim is to make it more efficient, to make it more project-based, and essentially lower the cost of good projects, and adjust the costs correctly to weight them. But this is definitely something that we will also figure out along the way when the risk assessments happen, and as it moves along.
I would say you probably have pricing in two categories of things. So one, and when I mean pricing, I sort of mean the overall, I guess, profitability or revenue, that a developer either makes or has to give up. I think one, you have the risk assessment that leads to the buffer contribution. So For that, like, we can't promise it will be less. I think that wouldn't be a safe thing to promise. I think what you can promise is that it will be done in the same way we would assess a risk for our insurance portfolio. And that for some project developers, it might be lower than it otherwise would be. And for some, it might be higher based on that risk assessment. But it will be done in a very consistent and basic insurance-driven way. The same way we assess you for an insurance policy will be very similar to how you'd be assessed for your buffer contribution. And it'll be transparent as to the outcomes of that result for you. And then I think we can also make it slightly smarter in that you do the risk assessment and then you're managing the buffer, you can see actually which projects are performing well. And so over time, just like if you have car insurance and you might get a sort of no claims bonus, you know, like you haven't had an accident ever, yay, great driving, here's some money back. I think you can over time have that kind of thing. And I think there's other ways we can over time maybe be slightly smarter and recognize that in the early stage of a project's life is a challenging time to be doing a large upfront contribution. But then the other side of, I guess, the flip coin, when you're looking at insurance for the buffer or the sort of pricing for buffer as a service generally, always the most cost-effective way to do something is to charge a central entity that can then pass a cost out to the many projects within it. So if we charge ICR, it's a relatively small percentage centrally. The actual cost of us doing, let's say, insuring their buffer, the actual cost that puts onto the project developers is negligible. And if it then leads to buyers, investors perceiving those projects to be more risk safeguarded, be higher quality, anything of that might provide a even nominal uplift in the value of those resulting carbon credits, the price is going to be canceled out. And that's just the pure economics of, if I charge everyone individually, it's going to cost them a lot more than if I charge a central overhead, like a central agency that then filters that cost down amongst many. And so I think that's the core structure of buffer as a service. Any form of sort of insurance for the buffer is based on that central pricing mechanism that filters out to a nominal cost for anyone else, versus insurance for project developers directly, or anything else that's charged them directly, which this is not. If that makes sense. You sort of have the buffer contribution and then you have the actual price of, let's say, buffer insurance, two separate things. But the goal of all of it is to have price efficiencies and to really benefit the highest performing project developers.
I mean, before we move to the Q&A session, I would like to ask if there's anything you would like to add that we haven't covered in the chat of how buffer as a service works or the partnership and so on. Of course, at the end, we will have some closing remarks. We will maybe share a little bit about what are the next steps for each one individually and for the partnership. But is there anything that we haven't covered that you would like to address? No? Okay. All good. Then I think, like I said, Gumi will join us for the Q&A, and we already have some questions. So
we also have Paul, who's my co-founder, who also is the technical lead for Buffer as a Service, is sitting here with me, and he's also willing to take.
The more the merrier. Gumi is here with us. So if you have any difficult questions, the CEO will be very happy to address them. All right, so let me start this. The first question comes from Gaurav, and he is asking the following. How can startups effectively navigate the complexities of carbon pricing and compliance requirements when seeking insurance coverage as a risk assessment? So it sounds like it's a Kita question.
Sorry, do you mind just repeating it quickly?
How can startups effectively navigate the complexities of carbon pricing and compliance requirements when seeking insurance coverage as a risk assessment?
Pricing and compliance. I'd say the only reason I asked to have it repeated is the pricing and compliance is where I could take that probably a few different ways. I'm not sure if they're talking about the pricing of insurance or how do you comply with an insurance policy, or if we're talking about more widely. So if you have any clarification that you'd like to enter in the chat, please do. Otherwise, I would say, given you reference startups, I'll note that startups, again, tend to have limited budget, small teams, and thus you might be very, very overstretched. I say the way that we tend to work with people, so if you're coming to us for an insurance policy, or if we were working with you on a risk assessment, what have you, we tend to always try and work in a pretty partnership-driven way. We work on the assumption that your starting point is you don't understand insurance, because why would you, right? Why would you understand the nuances of carbon insurance in and of itself? And so we tend to spend a lot of time with people we work with to try and explain the intricacies and talk you through the nuances. And we do not charge you for this time. And so to some extent, someone once called us like a consultant. And I think that would probably be my answer. In terms of the pricing and compliance aspects specifically, I might just need slightly more clarification as to what particular aspect you're considering, unless you have any further views on that.
I guess I would add that it's on us to make the products as accessible and easy to use as possible. It's very much in our interest not to add burden. And to some extent, one of the excellent things by working with ICR has been the fact that they're very tech enabled. It's been very straightforward for us to integrate with them, so there's no need for us to re-ask a lot of the same questions. We can, share the data model, share the data to try and lower the burden of things that you have to answer in order to get to the cover you might want.
All right. Is there anything on the ICR side we would like to add about the complexities of carbon pricing? Always an interesting question.
No, maybe I'd like to add that I think having insurance companies analyzing portfolios, trying to assess this, will definitely have a positive impact also on price discovery in the future, on how you will assess prices and why, because a lot of the time I think the buyer feels it's like they don't really understand what it is they're buying. They understand that they are buying let's say a car, but they can't really understand if it's a new one or a used one or whatever. So I think having them to analyze the risk portfolio will give them much better analysis of that, and because they will also price it in, because how much it will cost them, they will also need to or insurance companies will need to have an opinion on how much these things will cost. So they will also provide price or should provide price points in the future.
And actually, Gaurav, he sent a clarification and he said, "Thank you for answering. I meant the carbon credits value being secured."
So I guess one of the things I could say about that is that both the introduction of like good risk management, transparent risk management at the standard level, and also the introduction of insurance on the project level, whether it's direct or via the standard, all give more certainty of outcomes. And so with more certain outcomes, it allows you to basically make it more, the value more certain. Because if you think about somebody who's purchasing a credit and has to take on risks themselves, because there isn't these protections, what they do is they discount the risk. They will say, actually, I won't buy that credit for $10, I'll buy it for $8, because that way I've built in the risk management that way. Now that's obviously a very crude way of doing it, and it also means that devalues the credits to a certain extent. So I think this is not something that will happen overnight, but as we can demonstrate and keep on delivering this sort of certainty around delivery, certainty around the quality, then those price variants, the market discounting will decrease. And I think that's one way we can secure those further prices, by giving that certainty and security about those future points.
All right. So we have a few more questions. I can read them to you. I think you should be able to read them as well. Can you read them on your screen, Natalia? So because sometimes they're very long, so it's reading them out loud, something can be left out. So Mark Mersman is asking, how will vintages be managed relative to insurance underwriting and renewals? Will renewals be annual or multi-year, and who will pay after a purchaser takes possession from ICR?
So vintages managed, renewals, it depends on the insurance. So we've talked about a few different types of insurance here. So we talked about delivery risk insurance for ex ante. We talked a bit about political risk insurance for your Article 6 credits, or your COSIA, your corresponding adjustment. I mean, we talked a bit about buffer insurance. So I say what you are insured for is going to then dictate how we look at your project, how we risk assess you. If we're looking at political risk and corresponding adjustments, it's relatively specific to the country and the type of carbon. If we're looking at delivery, it's a much more comprehensive kind of risk perspective. And so those types of insurance policies will also dictate the length of your insurance policy. So for ex ante credits, recognizing these projects can take a very long time to deliver, we can insure out to 10 years. For political risk right now in today's environment, we're probably not comfortable going out more than 2 or maybe 3 years, just because of the fluctuating risk levels. For buffer insurance or anything else that's portfolio based, where that portfolio might be changing dramatically year to year, it probably makes most sense to do an annual policy such that you can continue to reassess and revise that risk and therefore the price of the policy. And so thus the renewals are going to depend on what you're being insured for. And therefore also the vintages in terms of, I guess, on the basis that, unless you're misunderstanding this differently, in the instance, let's say you do have a loss and you wish for the insurance claim to be repaid in carbon credits, considering the vintage could be one aspect of how we look at the suitable replacement credits that we might be providing. And again, how we do that is going to some extent differ based on the length of the insurance policy that you're looking at. And then the final, what was the final aspect of that question?
I guess if you were looking at permanence insurance or something
like that.
Yes.
Yeah. Was the final, how does it transfer? So again, probably insurance doesn't always transfer very well. I'd say buyers, if you are insuring the buffer, the buyer is almost inherently protected. So they already often will in essence de facto be protected by the buffer, as the buffer is intended to ensure permanence for the buyer. So if we insure the buffer, what we're in essence doing is providing an extra level of certainty to the buyer. So actually a legal contract that outlines if X, Y, and Z losses occur, this is how the compensation will happen. And again, depending on how the insurance structure is structured, that buyer could be compensated directly as what we would term a loss payee, or they could just have the further certainty of that sort of creditworthy wrapper around the buffer that actually even further certainty that they're protected just by that risk management mechanism. Other types of insurance can potentially transfer, let's say, from the buyer of insurance to another party. That is possible, or probably most common is you would have the buyer be what's termed a loss payee. So let's say I'm a project developer and I've purchased insurance for delivery risk, but really if there's a loss, the loss is experienced by my buyer. The project developer could be the buyer of the insurance, but if there is a loss, the insurance company could pay directly to the carbon credit buyer in what we would term a loss payee structure, if that makes sense.
Yes. Thank you for addressing that question. We have a few more coming in. The next one is from Sioer. I think if I pronounced it correctly. The question is, in first phase of carbon insurance, the existence of buffers were criticized. Is it contradictory to see KITA insuring buffer? And why are we having buffers if we can insure under delivery of carbon sequestration?
Do you want to take that one?
Yeah, I'll start. So I think, as we said earlier, to start with, there was no insurance, and really there's kind of the mutualization of and sharing of that risk by the developers contributing was the only form of like a backstop that would basically ensure some integrity across the standard level. I think we can't just go in overnight and swap that out, because obviously the whole industry is would watch this very carefully, and any rapid change would not be well received, and people would be very concerned about whether the integrity is maintained. So I think what we're trying to do is add this extra layers of assurance and integrity, but over time you would often ask the question, well, do we need to have such big contributions to buffer? The risks are covered in other places, in which, of course, yeah, the long-term goal is to lower the burden on everyone and scale the market more quickly, not to add additional costs or barriers.
Mm-hmm.
Yeah, maybe or to.
No, maybe.
No, just to add a little bit. I mean, I think if you look at things also from a historical point of view, it's like, how else would you have done it? Else but using buffer pools. I mean, I think it's a very logical and understandable approach. But then, if you want to scale it, it's perhaps not the best or most efficient way to do so. But I feel it's very. I think buffer pools, as they exist, I think they have played an important role, but this is about the next step and improving existing infrastructure rather than anything else.
Yeah, I think we need to address we welcome all questions, even if they're difficult ones. So thank you for sending that in.
Yeah, just maybe comment a little bit on like, now we have been working with PITA and ICR have been working together since, was it April, on how we're going to structure the like increasing accountability in the space on buffers. So in the coming days, we have now we release or revise the documentation on how we are going to implement this partnership, and that entails a release into public consultation to gather feedback from our stakeholders. How this will improve the management of the buffer, and how insurances will play their role within the ICR ecosystem. So just to address few things that are being revised is that in the last version of the ICR requirements, there was an option for project developers to insure their different risks. So now we have outlined the requirements for such. Firstly, insurance companies. What is the insurance company? Secondly, what are the requirements for the insurance policy? The claim payment. What the requirement for that is that in cash or in time, and then evidence of eligibility and more, and then made it more clear on different types of risks. So we have discussed here about ex-ante issues, like a forward contract. Then of course the reversal risk, and then now we are also rolling out the requirement towards Article 6 to double claim risk. So this is all going to be released within the coming days. So we encourage everybody to engage in that public consultation because we want to do it well, and we want to get feedback from our stakeholders.
But if there's nothing more to add, I'm going to go to the next question, which I think is probably more on the ICR side. It says, can you purchase insurance on non-nature-based credits and projects? For example, the ones linked to methane reducing feed additives for cattle.
So yeah, I can try to answer that. So yes, there are we in the requirements. There's That's and now when we have released this, the requirements for the policy and the insurance company will be covered. So if there's an insurance company and an insurance policy that is available, then yes, but it needs to like adhere to the requirements.
Right, and we have some minutes left. We have a few questions, so I think we probably have time for one more question, which is a little bit longer about investing. So the question says, potential investors wanting to pair offset credits with new assets they are interested in purchasing have noted uncertainty in the gaps and variability in the scope of coverage available and duration of coverage that is more in line with the project's lifespan. Are there solutions coming?
I'll start with that. Yes, I'd say absolutely. It's our job as an innovator to bring the products that the market needs. We would love to have conversations with anyone and everyone regarding these, what gaps there are. On the particular topic, we are very conscious that the cover, the exposure of the projects will change over their life cycle and don't always necessarily match directly what you might experience if you were just basically buying the credits, for example. Investors have a different risk profile, banks have a different risk profile. This is exactly the sort of things we try to match and balance by combining that with working with the standard and with insurance.
Yeah, I was just gonna say, I'm not sure if there are gaps, 100%. I mean, insurance is still relatively new to this market, and so it takes time. And so like Paul said, that's one of the things we always like to understand where people think there are gaps. I wasn't sure from the wording of that question if some of the gaps meant the sort of lifespan of the project, in that these projects are 30 plus years, and you can't buy, it's going to be very hard, I would imagine, for you to buy a 30-year insurance policy. We often speak to people, like Paul just referenced, almost like remortgaging your house, right? Like if you have a project and if you're an investor and you're getting in really, really early, the risk profile of that project is going to be different on that day one than it's going to be at year 3 and then at year 10 and then year 20. And particularly for certain types of projects, the risk might be a lot higher at the start, and then it might drop down to actually a pretty manageable level. But if you're buying a long-term insurance policy on day one when the risk is high, the insurance company is probably going to charge you for high, just because that's the risk they're taking on day one, and they're not certain that the project's going to perform. So therefore, what we would often suggest to people is to look out to sort of a business time frame. So we'll get a lot of people looking for 5-year policies. I say that's probably most common. Yeah. So on day one, the risk is high, but in year 5 is when maybe you're getting your first issuance. And at that point, if the project's performing, it's going to have a very different risk profile. And at that point, you can renew the insurance for another tranche of credits. But I think that is probably the best way to evolve your insurance cover, both with the risk profile of the project you're insuring, but also realistically to evolve your insurance cover with the I guess capacity within the insurance industry and the products available and our ability to cover gaps and innovate over time. So we often recommend to people that they look at it as something that should be evolving as how they protect themselves, because the projects themselves are evolving, as are both the markets, both carbon and insurance.
I'd also add that it's quite common for us to talk to investors and banks where they've come with portfolios of projects, and those have got like a combined exposure profile, which changes very much. It's not good economic sense. It's not very economic to basically take out the maximum cover for the maximum exposure you might have over the whole 5-10 years, because guess what, 2 years from now that's going to change. So it makes much more sense for us to work with you to combine as Natalia said, like a waterfall tranches of insurance, which are designed to adjust to actual risks as they evolve and as they change in your portfolio. So you can lock in what you need, but you can leave other parts to float over time. And again, it makes more sense to like have these sort of staggered cover, legally committed cover that basically adjusts as your exposure adjusts.
Okay, thank you very much for your answers. It was really great to have Paul and Gumi joining us for the Q&A and for everyone who submitted questions. We have a few minutes left, so I would like to get some closing remarks from you. It's great to have a big part of the team that is working on this project, in the Buffer as a Service project. So I would also like to say that Natalia, just this week, Kita launched a political risk insurance product with the Tokyo Marine kiln, which is addressing carbon political risk cover. So congratulations on that. And to the whole Kita team, we believe that this is telling the insurance space is looking and will continue to be looking into the VCM and working with trailblazers such as yourself. So we are really happy to hear about this. And also, I think it would be great to finalize by saying, like, what is next for Kita ICR partnership, and what can people do now? What should our projects expect, and when will more or less the public consultation be out?
Yeah. So you want me go on the public consultation?
Yeah.
So maybe forgot to mention one thing that affects the project owners and the developers the most is how the risk assessment will be conducted. Now it has been stipulated that the proponent that conducts the risk assessment on any non-performance or permanence or now later that non-corresponding adjustment even. That now will be conducted by ICR and external risk assessor. So that risk will not be assessed by the proponent and the VVP that conducts like the assessment of the assurance of the project as a whole, but that will be conducted within ICR and with in partnership with Kita. On the public consultation slide, we hopefully will release documentation for public consultation before the end of the week, and that will at least extended for 30 days, and then we'll address the findings from the public consultation.
Wonderful. And what is next on the Kita side?
Well, I mean, on our side, I guess to note, one, that we think it's a real honor to be working with ICR. Two, I think we actually really recognize the responsibility of this. Like, we are trying to change some things that are very established in the market, I mean, together, and it has an impact, and we think that impact will be positive, but we do feel the responsibility to try and make sure it is. And so we very much look forward to the results of the public consultation, and to hear people's perspectives. And then I guess just the final point that I would make is that we're the service provider here, right? So we are providing a service to ICR, and ICR is providing a service to many of you on this call. And so we have tried to build this such that our service can be iterative and adaptive, as the market will inherently continue to adapt. And so we do see it changing, but we think that we should be able to build it such that it can continue to change in a positive way. But for now, I'd say it's been an honor, and we very much look forward to the feedback.
Wonderful. Any closing? Sorry.
I was just want to add, yeah, it has been really educational to work with Kita on this endeavor. Just to thank you for that, and like broaden the perspective of the limitation and the opportunities that are in this space. So thank you, Natalia and Paul.
And any words from Ole?
No, I just look forward to the next steps and getting things going.
All right. Thank you, everyone who joined today. We will be sending a link to the recording, and I think this would be it for today. All right. Bye.
Thank you.
Bye.